You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. This is the program for you, the beginning retail options trader, the equity trader is looking to dip his toe in the options waters and learn some more about what's going on out in the options markets. My name is Mark Longo from the optionsinsider.com, as well as from the ever expanding, ever exciting Options Insider Radio Network. If you haven't had a chance to check out all of our latest programs on the network, make sure you check out our new Trading Tech Talk. If you're into all the Flash Boys stuff, you've been seeing all the Sturm and Drang about Michael Lewis's latest and all the issues and controversy surrounding HFT in the world of trading, whether it's equities, options, futures, what have you, and how that breaks down if the markets are indeed rigged. Well, we break all that stuff down and much more on our Trading Tech Talk program. 2 episodes ago, we had a great interview with Blair Hull. He's a pioneer in the world of options technology. He has some really interesting and controversial things to say about HFT in the options and equity markets and what role the SEC has played in actually creating those HFT players. Our last episode, our most recent episode, was a very interesting debate on the Flash Boys book itself. So a lot of great stuff. If you're into that stuff, or if it's just kind of piquing your curiosity, you want to learn more, check it out, Trading Tech Talk. I think you're going to like it. And of course, while you're there, make sure to download our mobile app. You can stream all of your favorite episodes of Options Bootcamp. You can download them for offline listening. Maybe you want to come back to a topic down the road. What did they say about diagonals again? Well, you can download that one to your phone very easily, save it for whenever you want to listen to it on the plane, on the train. And of course, if you're listening to the show and you say, hey, I have a question about what they're talking about here, it doesn't make sense, I agree with what they're saying, I don't agree, you have a comment, whatever you want to send us, hit that comment, hit that feedback button, hit that email button, and you can send your question right over here to me and John and Dan and the host of this show or any other show you want to get in touch with here on the old network, and we'll route it appropriately. So great stuff. Check it out. The Options Insider Radio Network mobile app. I think you're going to like it. All right, and joining me on the old Bootcamp drill instructor squad once again is my partner in crime, none other than the Options major domo over there at Sogo Trade, Mr. John Critchley. John, welcome back to the program, sir.
Excited to be back after a little R&R with the family. Today we have a great and actually perplexing topic, and I'm looking forward to it. Should be a lot of fun.
Yeah, it's an interesting one, and it's kind of a bit of education for us as well, because we get to chew on some of the interesting ramifications of what's actually going on with this product and what it actually means for the marketplace itself. So without further ado, let's dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. learn. You're gonna learn how options work. Do you hear me? Yes, sir! You're gonna learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir! Call in. Prepare to learn. Yes, sir!
All right, everybody, welcome to the basic training segment. As the man said, this is, of course, the portion of the program where we break down some interesting new options topic for you guys to check out, to parse, to chew over, and to then implement into your own portfolios. And we were talking before the show about what would make an interesting topic here for the program, something we haven't touched on yet. And we've hit on little aspects of this on previous shows, but we've never actually gone whole bore into this topic before, and it seems like it's worthy of investigating it now. This is, of course, the mini options. We touched on these a little bit in some listener questions recently and some other various aspects of other shows. We thought it was time to kind of put the focus back on them completely, do a full episode on the mini options and kind of explore what's going on out here in the realm of the minis and why you may or may not want to use these products in your own portfolio. We'll leave that final judgment up to you, although John and I have our own opinions on these products. We'll get to those in a little bit, but first let's start off, as we always do here in the basic training segment, explaining just what the heck we're actually talking about. These are the mini options. As the name implies, these are smaller contracts than your typical equity and index options. Remember, on our beginning episodes, we talked about an options multiplier. Your standard equity and index option has a multiplier of 100. That means every contract is for 100 shares of the underlying. So when you want to calculate the actual cost, the actual price of that option when you're buying or selling it, you take the price that's listed in the options chain, and hence the name multiplier. You multiply it by 100, and that's the actual cost to you for a one lot. Now, of course, just thinking of that off the top of your head, that could quickly get pretty expensive when you're looking at some of the, shall we say, high-flying names out there in the options market. The Apples, the Googles, the Amazons, the what-have-yous. All these names that are $500 and north. When you start getting these very, very expensive stocks, well, guess what? They start getting very volatile. They move around a lot. There's a lot of deep-in-the-money strikes and other things. These options just become very expensive very quickly. And so now you have a situation where you have stocks like Apple and others that are very expensive, and people can't afford to trade options on them. And now that's a problem because that feeds back into the industry. The volume drops. These very popular products become less popular from an options perspective, and that doesn't really help anyone. So the industry kind of brainstormed for years about how to solve this problem, and two simultaneous proposals came up right around the same time. I believe one was from the International Securities Exchange in New York, and the other one was from the NYSE ARCA exchange out there. Both of them came up with proposals for a mini option, essentially a smaller contract size equity and index option. And what they all came up with was the notion of a 1/10 size contract. If you guys have traded SPY or other ETF options out there, you're already familiar with the 1/10 size contract. Those are smaller bite-sized contracts of things like the SPX. This is taking that same concept and applying it to your regular equity and index options now. So they said, why don't we take that multiplier and just divide it by 10, make it a 1/10 size contract yet again. So that's what the minis are. They are essentially, instead of a 100 multiplier, they are a 10 multiplier. And so they took that concept. This was back in April of 2012 when they actually started banding about the concept, and they took those two competing proposals, merged them into one, and applied to the SEC for approval. And this is usually something that takes a long time in the world of options, but for this product, because there was so much interest behind it, it really got fast-tracked. It got approved by the end of 2012, and it was listed a little over a year ago in March of 2013. You may think, wow, that's almost a year. It takes a long time to go from concept to listing, but in the world of options, that's actually lightning quick. So they listed it in March 2013. There was a lot of build-up to it, a lot of interest into it, and it seemed like it was going to be the home run product of the year. Before we get to how they played out, let's look even more at some of the details here. They listed them on 5 major names that are very retail friendly and also kind of pricey. So they looked at Apple. Of course, I named them before. They were kind of the test case for the mini concept, as well as Amazon, another pricey and also retail-friendly name, GLD, a popular ETF out there, Google, and SPY, another popular ETF out there. So they listed them on 5 popular retail-friendly names that are also somewhat expensive. They listed them back on March 18th of last year, and they decided, again, to have the 1/10 size multiplier. So you could think just off the top of your head how this would work. So a lot of interesting stuff happened in those early days of minis. John, before I keep going, why don't you give us your initial impression of the minis and some of the facts that are interesting to you about the minis?
Well, the minis, when they were officially, or when they were first discussed, and Mark can speak to this even more than myself because he's dealing with many different brokers and many different customers and clients. This was the most hyped and anticipated introduction of a new instrument, maybe since the weeklies, and maybe even more so than the weeklies. But so far it's been a very big disappointment, to be kind, for the option business. And maybe later in the show, Mark and I will get into the reasons why we feel they've been, let's say, not as robust as they should be. I mean, a perfect example today, I was in prepping for the show, Apple had earnings as we record and had a big move up. And at 10:30 Eastern time, so after an hour after the opening, the April 25 weekly regular standard option had done about 80,000 contracts, and the minis had done 1,000. Now that is a shocking number, especially when you consider that out of these 1,000 contracts, they're only worth a tenth of the deliverable as the regular. So
yeah, it's like 100 lot going up.
I mean, it's just shocking. I mean, also we had the announcement from Apple again last night about the 7-for-1 stock split. So now the king of options, which is Apple, instead of being a $580 stock, is going to be an $80 stock, and now the use of minis for Apple is going to become maybe less relevant. So there's been a few developments that have made the weekly options really very disappointing. I mean, even if when I look at some of the mini options to trade for myself, or maybe for a customer, I look today again at the April 570 calls. The weeklies were 146 bid at 151. That's a pretty nice tight market. I look at the minis, 107 bid at 185. I mean, it's a shockingly wide market. Now, again, we're going to go into later the reasons behind it, but they just haven't caught on as expected. And it's really too bad because, as Mark mentioned, one of the reasons why this idea was such a great idea in my mind and others is that we have a lot of customers at Sogo, and there's many, probably millions of customers that have odd lots of stocks. You can't buy maybe 100 shares of Google or Priceline or Apple, but you know what? Maybe you could buy 10 shares. And now, listen, now you can do a covered call. As we all know, the covered call is the starter place for most traders or most people that start trading options. So this would be a perfect way for a customer to get acclimated to the wide world of options by doing covered calls. So now you can do covered calls on Apple and Spiders and Gold and Amazon, but they just haven't caught on. So it's been a disappointment. I guess the jury's still out, although I'm not sure too much how much longer that jury is going to be convening before maybe they just pull a plug on these things.
Yeah, that announcement from Apple, the 1/7 stock split, really kind of obviates the need for minis on that name. And of course, Apple was really the test bed. Apple was the marquee case for minis in general. That was the reason people were bandying this about, that back in the days when Apple was trading $700. And now that it's splitting, and of course, looking at the numbers that you just quoted today, that 1,000 lot, of course, equal to essentially 100 lot of regular contract options. That's just mind-bogglingly low. That on a day like today, post-Apple earnings, a very high volume day, that the minis are just not even a factor, not even relevant. So how do we get here? That's an interesting question, and there's a lot of different factors involved in this. the minis, like we said, were really pitched as this use case, like John said there, about you have an odd lot, maybe you have 30 shares of Apple, you have 40 shares of Google, whatever the case may be. You can't really do much from an options perspective on them. If you write even a one lot of a standard 100 multiplier contract, you're over leveraged. You can't do that. Your broker's going to come in and charge you a ton of margin because you're essentially naked, a bunch of shares. So that doesn't really work for people. The minis were seen as an ideal use case for that. You have 30 shares, now you can write a covered call. You have 50 shares, now you can buy some protected puts, and it was going to be a great thing. And they were conceived to be very similar in other respects to regular options. They were going to have similar symbology. They're going to have the same, essentially the same underlying, same strikes, all that stuff, same expiration cycle. So it wasn't like you were making some weird non-standard contract. It was going to fit in very much with the current trading. If you had a weekly, you'd have a weekly mini. If you had a monthly, you'd have a monthly mini, et cetera, et cetera. And everyone thought that would fit very well. And then what we saw once they were launched was kind of the opposite of that. Like what John said, I think the initial surprise that a lot of people had was that when these products were listed, they were really perceived as going to be the slam dunk. This was going to be the thing that was going to bring a lot of the retail customers who may have been on the sidelines back into the options market in a big way. Now they had a way to play Apple. They had a way to play Google that was affordable to them. And what we're seeing is this very surprising number of different things going on in the marketplace at the same time. John hit on one of the primary issues with minis right now. You can trade the weeklies or the standard size contracts, and everyone who's traded an option, everyone listening to the show has probably traded at least one contract in their life. They've seen the options change. They know how tight and liquid most of the major series, most of the major underlyings are, particularly things like Google and Amazon and Apple. Now, you take those products and you go into the minis, it's a different ballgame entirely. The mini spreads are orders of magnitude larger than what you're seeing in the regular contracts. And so if you listen to this show at all, we've talked about execution, we talked about bid-ask spreads, those being a very, very important component of the actual cost of your transaction, not just commissions. And yet in the minis, people were getting run over. So if you wanted to trade a mini, you really had to want to trade a mini because you were paying substantially more from a slippage cost than you were just trading the regular size options. So that surprised a lot of people because people said, wow, this is going to be a new home run product. People are going to list this. Market maker is going to trade it really aggressively. It's going to be a good product to go back and forth for them between the main product and the mini product. It's going to be a good back and forth type trade. So they'll be very incentivized to keep those spreads tight and liquid. And we didn't see that. We didn't see a lot of market makers really jumping into that fray, which was part of the reason that the spreads were wide. The market makers that did jump in kind of played a wait and see game, saying, hey, let's see if some volume materializes before we really start quoting these things pretty aggressively. So they kind of kept those markets very wide. And we've seen them improve somewhat, but on a day like today, when a name like Apple, who's kind of the primary use case for these products, is still as wide as it is, that doesn't really help anybody. And that product's not going to trade. And making markets that wide, you clearly don't want to trade that product. And there was also another issue. Well, actually, there are many other issues going on with weeklies, but some of the other issues that were top of mind for weeklies that seemed to really cause a lot of problems were the brokers. They didn't really know how to treat these products. And unfortunately, a lot of the brokers really seem to view these as a bit of a cash grab. They said, hey, this is going to bring retail back. We're going to get people doing 10 contracts instead of one, so that's a win-win for us. And we're going to charge them the same freight to do it. Now, retail customers aren't stupid. They know that they're trading a product that is much smaller from a notional value perspective than a regular contract. So they know intuitively they should be getting some sort of discount for trading that product. And yet that wasn't the case at most of the brokers that listed these products. And again, not every broker listed them. John can get to that in a little bit as well. They all have different reasons for listing and not listing them. But a lot of the ones that did charged full ticket charge. So you're talking 10, 12, sometimes more dollars for the ticket charge, plus full commission, 75 cents a contract, more or less, depending on what they charge. So if you were doing the minis, number one, you were getting screwed on the spread. You were paying a lot more from the bid-ask spread than you were to trade the big size contracts. Number two, you were paying full ticket charge, which was just disastrous from not only from a PR perspective, really. A lot of these customers don't like to think that they're being screwed over by their broker. When you charge them full price for a 1/10 size contract, that tends to rub them the wrong way. So they didn't like that. And also, number three, if you tried to combine these with big size contracts, which was also a use case that these products were designed for, maybe you want to do 3 regular contracts and 5 minis or whatever the case may be. If you want to combine regular Apple and mini Apple or regular Google and mini Google, they would charge you ticket charges again. So ticket charge for the regular tray, ticket charge for the minis. So you were getting hit coming and going. You were getting hit on the spreads. It really was a disaster. And then add on to that, on all the different platforms where these products were listed, discoverability was and remains a huge issue. It's hard to find these things. They're buried in weird options chains. They have non-standard symbology that's throwing them all over the place. You really have to want to click them. Usually they're buried in 2 or 3 different tabs away from the main option chain. Most of even the standard quote vendors these days and others still make it hard to discover the minis. So there's a lot of issues at work that are really conspiring to make the minis, let's be charitable and say, a less than desirable experience from the end user perspective. And John, I'd have to wager that all of those issues weighing in on minis are a big factor in why Sogo chose not to list them.
Yeah, when they first came out, I was chomping at the bit. We had discussions with IT. I actually written up the specs for our IT to develop. But we decided at the time to take a wait-and-see approach, although I would have bet a lot of money that they were going to be very successful. So we were ready to go. We decided to allocate our resources elsewhere to where we believed it could most benefit our customers immediately. Like, for example, our optimizer, which I've talked about in the past, that gives our customers enhanced margin capabilities, advanced screener, which we just launched. So instead of taking away resources from our IT for the minis, we took a wait-and-see approach. But we were ready to go if we need be, and we still are. If we see these products at some point getting traction, then we will reconsider our decision, and in relatively short order, we're going to be able to list them. But as of right now, there's just not the clamoring, and I'm not going to request IT to devote resources to something that is not benefiting the customer and not benefiting us. The one thing I wanted to mention, and Mark and I had talked about this, and this is Mark's idea, he brought it up, about which is very much in vogue these days in conversation. I'm an ex-market maker, so is Mark. So I have a tendency as a trader and market maker to be pro-market maker. When I saw these wide markets, it really kind of perplexed me and befuddled me. And Mark actually came up with the answer why he thinks that might be, and it may be a factor of this high-frequency trading. Maybe the market makers don't want to get arbed or picked off on the minis versus the regulars, so they're going to make them very wide. That might be the case, but for the time being, Sogo is not going to list them, and that's just is how it's going to be. And we also, Mark, we get very, very few requests for these minis. Maybe once a week or once every few weeks I get a customer calling in. So no one's really clamoring for them. So until that happens, we're just going to sit back and provide, the service that we provide at rock bottom prices and just go with it.
Now, it's not often that I say here on the show, yeah, I agree with your decision not to list a product, but in this case, I'm very hard-pressed to think of a scenario where I would actually recommend to someone, you should use a mini for this. These products are just broken in their current format, and just the spreads alone that you mentioned are a reason to steer clear of these things, let alone the other things I mentioned, like commissions and other things. So I really can't recommend. I was going to have a section here on this segment, like we always do in basic training, when you should use them, when you shouldn't. I really can't come up with a lot of scenarios where you really should use a mini. I suppose if you have 20 or 30 shares of something sitting in your account and you really want to write a covered call or buyer protective put on it, then you could use a mini, but just be aware of all those issues we mentioned before. You're going to pay full freight to do it, and you have to really work that order. You have to come in aggressively mid-market, sit on top, and babysit that order until you're filled. Because the spreads are so wide, there's no liquidity out there. No one's going to step up to fill you. So you're going to have to wait a little while for that order to get filled and work it pretty aggressively. And even still, you're probably not going to get the fill you want. When you compare it to the prices of the big option, you're going to be paying worse prices. It's just a fact of life. So if you're okay with that built-in cost of the product, I suppose you could go and use it, but you really have to really, really want it and really, really need it, I think, to do it. And to your other point there, John, about why the spreads are so wide, and this is a very controversial topic. I've talked to a lot of different people about it. I have my own opinions, obviously, because like you said, I was a market maker as well, so I'm still very close to that community, and I pay a lot of attention to what's been going on. And to me, this is one of the first big major industry-wide new products that's been launched in this, I guess you can call it this post-HFT, post-modern era of liquidity providing, where a lot of the original liquidity providing firms that specialize in making markets and options have been just squeezed out of this business in recent years by a number of things, by decisions to go to penny pricing and options, by payment for order flow and options, taxing everyone to death, by these HFT guys coming in and flickering quotes, and by doing so, cherry picking a lot of the quality order flow out of these products where they don't have any of the risks associated with being a liquidity provider and all these other things that kind of add up to a huge burden on this community. As a result, the community has been decimated of liquidity providers. There are very few firms left dedicated to doing this, and they're very gun shy as a result to list and take risk in a new product. So even something that you think would be a slam dunk home run like a mini Apple, they're very tentative. They're scared little bunnies now about listing and spending the resources and taking the risk to list a new product, make the market tight, when they don't see a lot of volume coming into it to begin with. A lot of these market makers are playing the same game you guys are at Sogo there, John, where they're playing the wait and see game because they kind of have to. They can't afford to spend a lot of time and resources and take a risk in a product that they don't know is going to be a home run. That's not something you would have seen in years past when that community, I think, was a lot more robust. And I think, to me, at least my own personal opinion, others may dispute this, but I think this, what we're seeing in the minis, is emblematic of the damage that's been done to that community, where even a product like this, a relatively home run from most perspectives, is pretty much being left to twist in the wind with ridiculously wide markets because they have no incentive to come in there and really make these markets tight. Because once you start doing that, all these other issues come to play, and it's not really worth their while as a market maker until there's a lot of customer volume, and the customer volume doesn't come until there's tight markets. So it's a vicious catch-22 cycle. So it's, to me, this is emblematic of just a lot of the wrong-headed decisions that have been made by the regulators and others over the years that have just piled needless damage on that community over the last decade. And now we're seeing the end result of that. New products are not getting tight markets, and they're not getting a lot of liquidity behind them because the guys who used to be paid to do that are gone. And at the end of the day, whether you're pro HFT or not, I'm not going to take a stance on that here on this show, but those guys aren't going to come in and make liquidity in a new product. That's not their gig. That's not their job. So you're left to the dedicated guys, and those guys are going to keep it wide as a truck until they have incentive not to do so. So that's kind of my take on that. I won't get too far down that soapbox of that. There's a lot of Sturm and Drang about HFT. Is it good? Is it evil? If you want to check out more about that, I encourage you to check out our Trading Tech Talk show. We get into that in all of its glorious and insidious detail. But it's an interesting topic, and you start to see now how these things start to filter in to even the very basic retail trader in terms of the impact on the marketplace. And that's a clear, I think at least, impact of how this is all fed back into the liquidity providing community, and now we're seeing much less liquidity, much wider markets on some of these newer products. So that's my takeaway there on minis. John, anything else you want to leave us with on minis before we jump into some listener questions?
Yeah, I want to touch on one thing very quickly, and that is, the commission charges. I mean, you can be a third grade math student, and if you look at the commission charges, I did an example. I just tried to figure it out myself, and when I bought some options in Apple, the broker's commission was about 1%, let's say, of my profit. I made a profit on a trade. And then I did the same outlay with a mini option, and then the commission took 12% of my profit. So, it's just once the commissions come down, and that takes more programming by all the brokers. And we also have to factor in the case where, how do these brokers figure out, or how do we figure out? And this, when I was actually going through the specs, the hardest thing we had was, and we finally came to the conclusion that we're going to separate the minis from the regular and not count them against each other, which is not that customer friendly. But the math behind saying, well, I'm long 10 minis, okay, that I can hedge that against one regular. How about if I have 9? How do I hedge 9 minis versus one regular? I mean, the math behind the hedging and the margin is very tricky also. So, maybe they take off, and maybe they don't. Let's just sit back and wait. and see what happens. But I think the damage that these high frequency traders have wrought, I think, is finally starting to come to light. And Mark hit on it, and I never thought about till we discussed it, that might be the reason why the markets are so wide. So they're now destroying this market now too. So until we can fix that, the minis might not be that viable product.
No, and now that Apple, like we said, has made that announcement, it really seems like that's going to be the beginning of the end of any hopes of any volume for these products. Once you have a stock split in Apple, the use case for minis really dries up. So again, I wish we had a better tale to tell you, listeners, to tell you to go out and run, don't walk, to start trading these products. But unfortunately, we really can't do that. I would recommend, and I think John would as well, you stay clear of these, at least until they get some more clarity around them, better volume, better pricing, or until they're pretty much delisted. I don't know. Out of the two, I might have to wager on the latter happening before the former. We'll see. But interesting stuff. We'll certainly keep an eye on these, and if they do improve, we'll let you know, listeners. But as of right now, as of April 2014, I certainly wouldn't run out and start trading some minis. All right. That's going to do it for our basic training segment. Now we're going to keep on rolling right on into your segment, your part of the show, because it's time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome back to the mail call. This is, of course, the portion of the show where you guys take a seat with us on the old drill instructor squad, make your comments, your questions known. First up, we have a quick one. It's actually a follow-up from a listener who goes by the handle Maximus. He writes in, "Hi, Mark. Hope you've been doing well. Following up in connection with my question in the email below," and he's referring to another question he had a while ago about Roth IRAs. He ends his comments here with, "Once again, I think you and your panel do an absolutely fantastic job at spreading knowledge across several podcasts on your network. Please do keep up the good work, and I hope you're able to produce more podcasts more frequently. Thanks in advance for your assistance. Look forward to hearing from you soon. Take care and be well. Maximus." Well, we produce quite a few right now, Maximus. I don't know how much more time I have to do new shows, even though we are planning a number of new programs. So I think you're going to get your wish. And moral of the story, this is the question about Roth IRAs, and we just didn't have time to get to it on recent shows of Options Bootcamp. And I know you wanted your question answered. You've been waiting for a while. So we actually answered it over there on the Option Block program. Those guys stole the question out from John. I'm sorry. So if you want to check out your answer, surf on over to the Option Block and check out that one. It was actually a very recent episode on there, and you'll have your question answered for you. So there you go, Maximus. Thanks for writing in. And unfortunately, those guys post that question from you, John, but we'll get you some more. Don't worry. In fact, next up, we have a question here, or I should say, just like this next question from a listener who goes by the handle, or maybe that's his name, I don't know, Marco. And he writes, "This one is for the Bootcamp Drill Instructor Squad, probably John." Well, there you go, John. Here's your very own question. He writes, "Can I open 2 accounts at the same brokerage firm? Not an IRA and a regular account, but 2 regular options brokerage accounts. I want to have an account for my regular income trades and an account for other more speculative strategies. It's easier for my systems if I keep them separate. I'm aware that I won't receive offsetting margin, etc. Is this a possibility, or is there some prohibition against this? Thanks for answering, and thanks for sponsoring the show. It's a great program that is helping a lot of people. Still can't believe it's free." Well, that is a good point. We do a lot of free education for you guys. I'm glad to see that you guys appreciate it. This is an interesting question, John. I don't think we've ever received anything like this before. Maybe you guys have over at Sogo. Someone who wants to essentially house his different strategies in different accounts. Is that something you guys, or indeed any broker, can really accommodate?
Yes, we can. I mean, what the rule is that a customer can have one margin account and, in theory, unlimited cash accounts. And we do have customers that I speak to regularly that will have one margin account and multiple cash accounts. The one thing I will say is that there's no cross margining. That's very difficult, and we don't allow that. But I'm not sure if any brokerage allows that. So they're all separately margined, all different accounts. So the one thing I will say is that if a customer opens an account and opens 10 different cash accounts, there's going to be some compliance. Extra layer of compliance. It will come to me. I'll look at it. I will call the customer up, and we'll discuss, why are you opening, 5, 10 different cash accounts? And if the reason is good enough, well, I want to do all these different strategies, then we'll allow it. But we do allow, and we do have customers that have multiple cash accounts, and they have different strategies in different accounts, and they like to keep it separate. And I think one of the reasons is also because the tax, the way that the taxes are, and the way the end of the year withholding and the end of the year tax implications, customers like to have these customers separate accounts for different strategies. Now, do remember, in a cash account, you're limited to certain strategies. You can't sell naked options, so you only can do up to level 2 strategies. But if you're going to do some level 2 strategies, you can have as many accounts as you want. If a customer wants to open multiple cash accounts and they find a difficulty at SogoTrade or anywhere else, they can always send me an email at jcritchley@sogotrade.com or call our main number and call me directly, extension 168. And, I'll talk to them. And if it seems reasonable, I'll walk down to the compliance and we'll get them all set up.
There you go, listener. There's your answer. You can do it, just maybe not in the way you perhaps envisioned. Like John said, you can't go slinging all of your crazy margin strategies in each one. You probably want to, and it sounds like you want to do this, keep your more exotic speculative type strategies that probably do involve margin in that one margin account, and keep the rest for the cash accounts. Those are going to be the covered positions, the covered calls, the cash secured puts, that sort of thing in the regular cash accounts. But if you're okay with doing that and you're okay with not getting the offsetting margin, and it seems like you are, then you could certainly do that. Just again, don't go open 27 accounts, because then you're going to get a call from John. Why are you doing that? Are you laundering money through Sogo? Blah, 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 all that fun stuff. So interesting question, though. I don't think we've ever received anything like that on the old program or on the network before. All right, next up, we have a question, a quick one here from listener goes by the handle Lil Tim, and he writes, quick question about vol. Are realized and historical vol the same thing? And are there any pricing models that use historical vol? Thanks, Lil Tim. Well, good question, Mr. Tim. And the short answer to your question is yes, they are the same thing. They're two different terms for the same thing. People call it realized because that's the volatility that the market has actually realized or seen over time in the marketplace. That's the volatility the underlying has actually exhibited. They also call it historical for a similar reason. It's the actual volatility that the underlying has displayed over time, over history, hence the historical nature of it, but they are both the same thing. As for pricing models that use historical vol, well, vol is your fudge factor in most pricing models. You can use whatever vol level you want. If you want to use historical vol or realized vol, you certainly can. But there's a big problem to that. You're probably going to be selling a lot of options then, because you're going to be dramatically undervaluing all of the options that you're seeing out there. Because remember, we talked about this in our implied volatility episode. There's realized volatility and there's implied volatility. Implied volatility is the actual level of volatility that is being implied or inferred from the prices in the options marketplace right now. The actual value, the actual price that those options are trading, those imply a certain level of volatility. And implied volatility is almost always 9 times out of 10 going to be higher than realized volatility. The market just generally overestimates vol. It's a known phenomenon. They call this the risk premium of the marketplace, and it depends on who you talk to. Some orders of magnitude, how that risk premium varies depending on the product. Some people say 6% more or less. It really depends on who you talk to. But in general, there is a risk premium. In general, there is a higher level of implied volatility in the marketplace than there is realized. So if you're pricing all of your models off realized, you're going to be consistently undervaluing options, and you're going to be incentivized to sell them at levels that maybe you probably shouldn't, because that's not where they're trading in the marketplace. So you're free to do that, and you can use whatever vol level you like. It's just a question of realizing what you're actually doing, pun intended, that you're actually using a lower level of volatility in most scenarios. There are times when realized will outpace implied, but those are very infrequent, and those are usually things that are worthy of note and worthy of watching and perhaps worthy of trading, because volatility typically being mean reverting, those scenarios are usually going to come back to normal. But you are free to do whatever you like. Just be aware of the ramifications of using historical vol in your models. Mr. Critchley, anything to add here for our friend Lil Tim?
Now, the one thing I will add is that I know we plug this platform a lot, and now they're a competitor of ours, so I probably shouldn't, but LiveVol has a chart that, or other places may have charts that you can you can look at the implied versus historical, and you'll see exactly what Mark's talking about, where the implied volatility is almost always going to be higher than the realized volatility. And the reason being, and Mark hit on it, but just let me add that if it wasn't the case, then a trader could buy volatility, which means buys options, and then if they had the proper hedging mechanism, which we learned on the floor, they could hedge every single day and theoretically never lose money. And then if they get the one big outlier move in the underlying, which happens every so often, they'll make a lot of money. So that's one of the reasons why the implied volatility is always going to be a touch higher. There's risk premium. No one knows what's going to happen overnight, so it can't really be lower. I mean, it doesn't really make sense. But if you look at a chart, and you'll see that in a chart, and you'll see also sometimes where when those two lines collide or become very close together, that might be an opportunity for the customer to maybe buy some options. So those charts, live vol and other programs are a very good resource to use to make your option buying decisions.
Yes, and if you're interested in volatility, I of course encourage you to check out our Volatility Views program, where we get very deep into the weeds on topics just like this, and we talked quite a bit about that risk premium in the marketplace, that implied versus realized volatility. We have over 100 episodes devoted to many similar topics, so go check it out, Volatility Views. You can learn a lot about this exact topic, more than we can go into on a program like this. All right, next up, this is another quick one. This one, right up your alley, John. This is a question from Avery, and he or she writes, "Help, my broker hates options. What should I do?" I like this one. So, John, what should Mr. or Mrs. Avery do if their broker hates options?
Well, So Good Trade loves options. So do I. So does Mark. To me, they're the most incredible investment instrument that's been created. I don't want to say ever, but in a very, very long time. I mean, we fight this perception. Mark fights it more than I do, and a guy like Joe Burgoyne at the OIC fights it probably every day. This perception about the risky nature of options. I think we've had a podcast on it, or we've done an episode on that. But the broker hating options is based upon, to be kind of brutally honest, based upon ignorance and not knowledge. Options are a risk reducer. They can generate income. If you listen to a show like this and other shows on Mark's network, and if you come to our website or OIC's education and you learn about options, exactly what Dan Passarelli says and I say, Mark says, learn about options. They can be risk reducers, income generators, and they can help you. They can be speculative if you like. That's your choice. You as a customer, okay, need to get educated. And if your broker hates options, then they're uninformed and they're out of the times. It's a widely held perception that Mark and his other, if you listen to Mark's, The Advisors podcast, they'll talk about that a lot. It's a perception that we try to break down every single day. And, if a broker hates options, they can always come here. My extension is 168. Give me a call, send me an email. I'll send you any kind of literature you want on the studies and other things. And you learn about options and you'll make some money, or you hedge your risk, either or.
Yeah, this is an interesting question. It sounds kind of silly on the surface, but one of the reasons I bumped it up to be answered on the show is it does address a larger issue in the marketplace. And this is actually a refrain that we actually hear quite a bit and that we see quite a bit in the marketplace. It's amazing that still, in mid-2014 or so, we still see a lot of major brokerage firms who take a, shall we say, less than charitable viewpoint of options. They have a dated, antiquated viewpoint of this product as being some sort of risk additive type product. I think back to the Nick Leeson days of writing downside puts and straddles and things like that. And I think anyone who trades options is going to blow out. It's not helped when mainstream publications like the New York Times write articles that essentially say exactly that, like they did last year with a big article slamming retail customers using options as most retail customers lose money, et cetera, et cetera. That's a very dated and a very antiquated viewpoint. And unfortunately, unfortunately, there are still a number of brokerage firms out there that take it, particularly ones that are a little bit more in the legacy equity world. I think, for lack of a better term, they view their customers as primarily equity customers, maybe some financial advisors out there, and they think options are going to come in and just blow out these customers left and right. And like we've said on the show many times, and we've shown over all the many different episodes we've done, options are actually risk mitigating, not risk adding, or not risk additive to a portfolio. In fact, it drives me crazy whenever we have to put that stupid options disclaimer on the front of every show, is that options are not suitable for all investors. I actually don't believe that. I think options are suitable for all investors. I think there is an options position that would be suitable for pretty much every different scenario out there. If you want risk mitigation, if you want to hedge and protect, every single investor could benefit from that, from lowering their overall volatility of their portfolio, lowering their risk, increasing their returns perhaps, or at the very least, lowering their risk. That's a great thing for everybody. And everyone should have that use case in their portfolio. And so coming out there and saying they're not suitable for everyone, that's legalese that was crafted by the lawyers. Unfortunately, we have to stick to that for compliance reasons, but I actually don't believe that. I think options are suitable for pretty much everyone out there because they can come in and lower your risk, and that's what everyone wants to do. So a quick, silly question from Avery, but it hits on a larger point. And again, John brings it up, but Sogo clearly committed to options, as are the other brokers on our network. You can look very quickly at who's on our network, who takes options seriously. And if you're looking for that, that's how you choose your broker, if you're coming to it from an option-centric perspective, and we think you should be, because everyone has equity functionality now. Everyone has equity pricing. Options are really where the game is being played. That's where your consideration is. Take a look at Sogo. Take a look at the other names in our network, and you could kind of make your own decision there for who's best suited for you. So there are a lot of brokers out there who take options very seriously. Of course, Sogo being one of them. And you should give them a second look because they want your business and because they actually will reward you for coming to them with some actually interesting options tools and functionality like the portfolio optimizer that John's always talking about, and things that will actually improve your trading. So check those brokers out because they want your business and they will reward you for it. All right, last up, we have a question here. Comes in from a listener, just goes by Joe. Plain old Joe. He writes, love the show. Well, thanks, Joe. He goes on to write, I look forward to my fresh episodes every couple of weeks. It's my treat during my commute, although my wife thinks I listen to too many of your shows, Mark. Well, I think she and I will differ on that point, Joe, but she's your wife. You probably want to go with her opinion at the end of the day. Keep things happy in the home sip. He goes on to write, anyway, I wanted to write in regarding our OIC conference. I've heard you mention this on several programs on the network. I don't live far from Austin, the site of this year's conference. I'm still a relative neophyte when it comes to options, although programs like this one are helping me to change that. Do you think it's worth it for beginners like me and others listening to this show to attend conferences like this? Is there any material there for me? Thanks for taking the time, and thanks for the network, Mark. You've got a listener for life. Well, thanks a lot, Joe. I really appreciate you guys listening, taking the time out of your day to listen to our content. That's the reason that we do this. Although if your wife is champing at the bit a little bit to listen to something else, maybe you want to tone down our stuff. It's all right. I'll understand. And about the OIC conference, it's a good question. I like to see that questions like this are starting to trickle in because it shows how the audience is evolving. A few years ago, you never would have gotten a question from a retail listener about OIC, and yet now we are, which is a fantastic thing. And this is the conference, as the name implies, is aimed at the options industry, so the professionals, the exchanges, the trading firms, the brokerage firms, people who make options part of their living. And we get into some hardcore minutia down there, things like OTC credit default swap clearing panels and things like maker-taker, payment for order flow. Of course, those latter things are becoming much more in the spotlight these days, thanks to Michael Lewis and his book that have resurfaced them and rebrought them into the public discourse again. So if that stuff interests you, it may be worthwhile. I would just, it's an expensive conference to go to. A lot of the value for people to going down there is, quite frankly, to network and meet people. So if you're not going to get that value out of it, maybe I would say save your money. Even though I would love to say, I've encouraged them before to do this. I wish they would have some sort of retail pass or exhibits only pass or a cheaper 1 or 2 segment session pass, because there are some good sessions you may want to attend. Dan Pastorella is going to be on one talking about options education, and there are other sessions that may interest you. And as we've all seen over the last couple of years, the developments that come out of a conference like this do impact your trading. Things like the different fee schedules at the exchanges and the way exchanges talk to each other with electronic linkage doesn't sound like the sexiest thing on the planet, but then you start trading and you can't get a spread off because one leg is on one exchange's siloed order book and the other leg is on another exchange's order book, and the two don't talk to each other. Well, conferences like this are where issues like that are addressed, as well as where products like the minis are born. So there are interesting developments out there for listeners like you. I don't think the pricing is there to make it worth your while, unfortunately. But there is a solution for you if you do want to attend OIC virtually. We go down there, we do a big explosion of radio down there every year, and we also put out all of their panels. So we will record them all for you. We'll put them out to this network as we have done every year in recent years. So if you're going to miss OIC, or if you want to check it out, but you just can't get down to Texas, or you don't want to foot the bill, don't worry, we've got you covered. We'll have all of the content coming out of OIC, so you guys can kick back at home or perhaps in the car with your wife, like our friend like our friend Joe here, and listen to all the panels at your own convenience. Anything to add here about OIC, John?
The OIC is a great conference, and I don't think it's necessarily for the retail customers. And I think what Mark does is just a great service. And I'm actually not going to be at the OIC, and I'm actually I'm excited, or I'm actually looking forward to listening to some of the panel discussions. So I definitely urge our listeners to use that service that Mark's providing, his network's providing, to listen to some of the panels, because he's right. A lot of these issues are born out of the conference. But unfortunately, we're not going to be there. I think Dan and Mark will be there. But look forward to hearing the different discussions and all the shows that Mark's going to do from down there. So I highly encourage everyone to tune in.
Yeah, and we should also salute the OIC people for allowing us to record this stuff. We've talked to a lot of other conferences over the years, and they're very precious with their content. They just want to do it once, and that's it. They don't want to preserve it or let it out to anyone who hasn't paid for the conference. And one of the reasons we go out there and record this stuff is for you guys, so you can have access to it, who can't make the conference, particularly you guys on the retail side who want to learn more about this. So we go make this effort for you, and we make sure that OIC is very accommodating of that, which is a good thing. So even though they don't have perhaps the right pricing for you guys, they let us come in and broadcast this stuff to you guys. So that's their effort for you guys to get a little more information on what's going on in the options market. Unfortunately, that's all the time we have for the mail call this week. It's also all the time we have for this episode of Options Bootcamp. But before we go, John, why don't you fill us in really quickly on what's coming down the pike over there at sogotrade.com?
Yeah, sure. We just recorded a webinar with Joe Bourgnoin of the OIC, and it's really for introduction to options. So maybe most of our customers that listen to the show might be too low of for them. But nevertheless, we're going to try to have more and more of these options, webinars scheduled. I'm running the webinar department now. I've taken it upon myself due to certain circumstances. So I'm going to be doing that. So now I have control of it now. So I'm going to try to do as many as we can. And you look forward to that. We have our mobile coming out. We're here in mid-May now. We have our screeners out there, and we have a lot of good stuff going on. So if any customer wants to shoot me an email, they can. They want to call Sogo Trade. My extension is 168. Feel free to call me with any questions or concerns, and we'll see everyone at the next show.
And even though he couldn't make it, I'll give him a plug anyway. If you want to learn more about what Dan's got cooking, check out markettaker.com, his elite trader community, all the other fun stuff, his personal one-on-one mentoring, his group coaching classes, all that fun stuff. Markettaker.com to learn more about that. And on behalf of John and even Dan, even though he couldn't be here, and of course myself, I want to thank all of you guys out there in the listening audience for downloading, streaming, subscribing to the show, and of course for sending in such fantastic questions. Keep those coming. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.